In the last episode, we walked through the mechanics of remeasuring our lease liability after the modification to our equipment lease. We updated our schedule, calculated the change in the liability, and recorded the remeasurement entry. The only item we have left is to reassess the classification of the lease as of the modification date, and that will guide how we update our right-of-use asset and lease expense going forward. So let's assume that because the payments have decreased significantly, the present value of our future payments no longer reaches 90% of the fair value of the asset on the date of modification. We'll also assume this asset, while high-tech, is not so specialized that it would have no use to the lessor at the end of the lease term. And as we noted when we first recorded this lease, there is no transfer of ownership, no purchase option we are reasonably certain to exercise, and the lease term does not cover 75% of the remaining useful life of the asset. So because of the contract modification, this lease now changes from a finance lease to an operating lease. So let's mark that down and then apply the guidance in ASC 842-10-25-14. The guidance states that when a modification results in a change from a finance lease to an operating lease, any difference between the carrying amount of the right-of-use asset after recording the lease liability adjustment and the carrying amount of the right-of-use asset that would result from applying the initial operating right-of-use asset measurement guidance to the modified lease must be accounted for as a rent prepayment or a lease incentive. And this is actually simpler in practice than the paragraph makes it sound. To account for the right-of-use asset as though this were a new operating lease, we would set the right-of-use asset equal to the lease liability of $129,357, and then add any additional prepayments to the lessor or any initial direct costs. But this modification didn't involve any such payments, so our right-of-use asset under the operating lease rules would simply equal the lease liability. However, if we look at our balance sheet immediately after recording the adjustment to the lease liability, our right-of-use asset balance is $135,902, not $129,357. And paragraph 842.10.25.14 tells us to treat that difference as a rent prepayment or lease incentive. So in our right-of-use asset section, we'll leave this initial lease liability calculation, but delete out the prepaid lessor payments and initial direct costs. We don't have any of those for this modification. Then we'll add in a line here and name it 842.10.25.14 application. The amount will be the difference between $135,902.44 and the calculated operating lease right-of-use asset of $129,356.68. And when we add that, our opening right-of-use asset immediately after the modification now matches the opening amount on our balance sheet. Now notice that if we instead approach this the same as we did for the remeasurement of our vehicle lease, we'd end up in the same spot. We'd set this first line to our pre-modification balance, and then subtract off the change in our liability. And that calculation also comes out to the $135,902 opening balance. But the previous way we calculated it follows ASC 842 precisely, so we'll leave that in place. And now to complete our right-of-use asset updates, let's set our opening balance on our schedule, and zero out the amortization in our opening period. Then the last thing we need to do is add our operating lease expense calculations. We no longer need the straight line amortization that applied to the finance lease, so we'll delete that and copy the operating lease expense framework from our 2.0 worksheet. Then instead of calculating the total consideration and subtracting the cumulative lease expense immediately prior to modification, we'll treat this as essentially a new operating lease. So we'll include our total lease payments post-modification. And then here, recall that the standard tells us to treat as a prepaid lessor payment the difference in the right-of-use asset after the remeasurement entry and how it would be initially calculated as an operating lease. So we'll set this equal to the amount we calculated under paragraph 842.10.25.14 above. And it's already referencing that cell, so no need to change anything here. We do need to update our straight line lease expense formula to reference the correct cells, so this will be our total lease consideration divided by the remaining lease term. And now, if we edit our amortization formulas for an operating lease by calculating the straight line lease expense less the interest, you can see we're successfully amortizing our right-of-use asset to zero by the end of the term. So the last thing we need to do here is just fix our check references. We'll set the lease expense to our cumulative expense in our last row here, and our total cash payments to the same row. And you can see we're actually 1 penny off. Again, this is a rounding thing between Excel and our accounting software. We're not rounding to the penny anywhere on our schedule here, while we are in our accounting software. So to fix this, we just need to treat our opening right-of-use asset balance as 1 penny lower, which is actually what it would be if we took the ending balance immediately prior to modification and subtracted the change in our liability we're calculating here. So we'll just edit this down to 43 cents, and now our check is showing true. And that's it for a modification that changes the classification of a lease from a finance lease to an operating lease. The other modification scenarios are more straightforward. Earlier, we saw a remeasurement of an operating lease that remained an operating lease. And for a finance lease, we simply amortize the right-of-use asset balance independently over the lease term, which is a much simpler calculation. So now to finish this off, let's update our periodic journal entry. We'll first update our identifier to 1.1, and then we need to change this from a finance lease template to an operating lease template, which we can do by replacing the interest and amortization expense with operating lease expense. So we'll just copy that here and paste over both of them in our equipment lease template. Then if we change our reporting date to May 31st, 2026, we can now post this entry as of that date. So back in our accounting system, we'll create a new journal entry. Let's first remit the cash payment to the lessor. Let's assume we do that on May 30th. So we'll post it to our ASC 842 clearing account. The payment in this month is $4,500. And we'll credit our checking account. Then we need to update our dates here to the end of the month. And you can see we have that $4,500 reflecting in our clearing account. So if we create a new entry for our ASC 842 process, this will be on May 31st, 2026. We will credit our clearing account for $4,500. Then first we'll debit our operating lease expense for our interest portion of $685.72, credit our current equipment lease liability for $404.67, debit our equipment long-term liability for $4,218.95, debit our operating lease expense for $4,054.46 for the amortization portion, and finally credit our accumulated amortization for the same amount. And if we save and close, we'll refresh our balance sheet. You can see our equipment right-of-use asset has now been reduced to $131,848. If we just spot check that against our schedule, here you see that balance of $131,848. And if we look at our profit and loss statement in May of 2026, before we've recorded any other lease for the month, we have our operating lease expense of $4,740.18, which matches the straight-line lease expense we're calculating on our new modified lease schedule, adjusted for rounding to the penny. And with that, we've completed lease reassessments, remeasurements, and modifications. In the next episode, we'll shift gears a bit and begin looking at lease impairments.